the Centralized Partnership Audit Regime.
All right, last one is the Centralized Partnership Audit Regime. The Centralized Partnership Audit Regime, which is CPAR. So whenever you see CPAR in accounting circles, that's what we're talking about, is the Centralized Partnership Audit Regime. Before CPAR, it was TEFRA. And TEFRA was the audit regime that was in place before the Centralized Partnership Audit Regime. This is a new audit regime that was implemented where if you have a large partnership or even a small partnership that doesn't opt out of this thing, because you can opt out of the Centralized Partnership Audit Regime if it's a small partnership. And generally we recommend that you do. But if it's a large partnership with 101 or more partners, so over 100 partners, then that partnership can't opt out. If it's a situation where the partnership gets audited by the IRS and adjustments are made, then they won't go chasing any of the individual partners for the additional tax. They will just assess tax at the partnership level. So this is the time where a partnership can pay income tax, is because of this, because of the Centralized Partnership Audit Regime. If a partnership gets selected for audit and it's under CPAR and the IRS makes adjustments, then they will assess the actual partnership itself. The partnership itself will be assessed the additional tax. The IRS will not go chase the individual partners for the tax. Eligible partnerships can elect out of CPAR on a special schedule, it's Schedule B2, if they file a timely filed return. So if the return is delinquent, you can't opt out of this thing anymore, which is terrible because CPAR is awful. But when an entity elects out, IRS proceedings and adjustments will be assessed at the partner level instead, which is what you want. So let's say you have a partnership that's small and it's 4 partners, but one partner is the one that's receiving the majority of the income. And if there's an adjustment, then most of the tax is going to be assessed to him. If that partnership doesn't opt out of the Centralized Partnership Audit Regime, then the IRS will just assess the tax at the partner level and the whole partnership will be responsible for it, which means every partner's got to kick in. But if the partnership elects out of CPAR, then the IRS basically has to make the adjustments at the partner level, okay, which is more difficult for the IRS, but it's better for the partners individually, obviously, right? Because it's going to be more equitable. The partners that actually owe the tax are the ones that are going to pay it. But under the Centralized Partnership Audit Regime, the IRS is just going to assess the tax at the partnership level, and then the partnership itself has to pay it. Now, I think you need to know which type of partnerships can actually elect out of this thing. If a partnership has more than 100 partners, so 101 partners or more, then that's considered a large partnership and the partnership can't elect out. Okay, number 1. Number 2, the partnership has to have only eligible partners, which means they can only be individuals, natural persons, humans, C corporations, S corporations, or estates of deceased partners only, not bankruptcy estates. So if one of the partners files for bankruptcy and their partnership interest actually passes to a bankruptcy estate because they filed for bankruptcy, then the partnership itself cannot opt out of CPAR anymore. Only the estate of a deceased partner is an eligible partner. A bankruptcy estate is not an eligible partner. An eligible partner also does not include a disregarded single member LLC, which actually ends up hitting a lot of partnerships in this case, because a lot of individual taxpayers will set up a single member LLC in order to hold their partnership interests. But if the partnership interest is actually held by a single member LLC, even if it's disregarded for every other purpose, then that's not an eligible partner anymore. It has to be held individually by an individual human person. If it's held through a single member LLC, then it's not an eligible partner anymore. If it's held by a trust, even a grantor trust, which is also disregarded for tax purposes most of the time, that's no longer an eligible partner anymore, or a bankruptcy estate. And this is true even if the disregarded entity is wholly owned by an eligible partner. Partnerships with non-qualified partners cannot opt out of the centralized audit regime, even if the partnership has fewer than 100 partners. Okay, so let's say you have a partnership, it only has 10 partners. Most of the time, that partnership would be able to opt out. But if one of the partners is holding their partnership interest through a trust, even if it's a grantor trust, then the partnership itself cannot opt out of CPAR anymore. Okay? And this is what the Schedule B2 looks like when they make the election out of the centralized partnership audit regime. You have to do it every single year. This is a sample. These are not real people. These are not real real taxpayers. I just made up these taxpayer identification numbers. But every single partnership that I do that can opt out of this thing, they do. Okay, they do opt out. So this is what the schedule looks like. It has to be attached to the Form 1065, as you can see up here. The taxpayer identification number goes here, whether it's an entity or an individual, and you put the type of eligible partner that it is. If it's an individual taxpayer, a natural person, then the partner code is I, okay? And you have to opt out every single year if you're gonna opt out, okay?
Subscribe to PassKey Online for more great content about the Enrolled Agent exam.